I'm always wondering what's the new SaaS metric that's going to come out. We've got rule of 40, we've got the magic number, we've got semi-new ones like the ROSE formula, which is just essentially ARR over headcount, but includes contractors as well, as contractors and consultants become more important. And what I've realized is those metrics are important. What's more important is how you evaluate them.
Hello, everyone. Welcome to yet another episode of the Optimize Show brought to you by SpamFlow. I'm Adi, the Chief of Staff at SpamFlow, and on today's episode, we are going to be talking about building a financial model that scales as you grow. And who better to talk about it than Kirk Kappelhoff, a seasoned professional with a strong track record in business modeling and auditing at Deloitte, KPMG, and EY. Today, he's the Director of Strategic Finance at DriveTrain, a financial planning and decision-making platform. Welcome, Kirk. It's my pleasure to host you today.
Adi, absolute pleasure to be here. Thank you so much for having me.
Super. To start off with, why don't you tell us a little bit about yourself and your experience in finance?
Definitely. Yeah, finance always piqued my interest. And going out of college, I got a job at Deloitte in their auditing team. And auditing is obviously very important and focuses a lot on the historicals. And the historicals are really important from an accounting perspective, but what really grabbed my eye was forecasting and looking ahead. How can we forecast out the model to make predictions, let's say, about revenue or expenses and those sorts of things? And so I found that opportunity at EY. And so I went over to EY and really got into modeling, creating complex models, and then found a very specific team at KPMG that did financial modeling itself. So it was specifically focused on the three statement models, the income statement, the balance sheet, statement of cash flows, and then anything that might feed those in terms of schedules. And I had some really good mentors there. They helped me learn how to create models. But then, of course, every consultant eventually leaves to the private world, and DriveTrain, which by all intents and purposes is the future of modeling, had an opportunity to be the director of strategic finance there. And I interviewed, met with the team, saw the product, and from an Excel perspective, I just couldn't imagine anything more efficient. And so that's what made me make that jump there. And so I'm still a lover of Excel, but at every point in a company's life cycle, they need to move to a tool. And I just couldn't think of a better one than DriveTrain, hence my jumping there.
Super. And I'm pretty sure you're the man to talk about today's topic, which is like building financial models that scale as you grow. And Kirk, typically what I like to do is sort of dissect the topic that we're talking about before we head into the different questions. From your perspective, why is scalability important when you're building financial models?
Yeah, no, that's a really good question. So, I mean, there's a variety of ways to think about modeling. I like to break it out into three sort of major categories. One is people, the second is process, and the third is practice. And so the people question is, how big is your team? How much time can they commit to these processes? Process would be, how currently are you updating your model, actuals, rolling the forecast, reforecast, and then practice, which is also known as industry. And this will obviously determine your kind of model. When we're thinking about scaling it, we're trying to make the people, process, and practice questions as easy to answer as possible. Meaning, what's the fewest amount of people I can use to maximize my efforts in the process part? What's the fewest amount of processes I need to complete in order to create an accurate forecast? And then from a practice perspective, this changes from industry. If you're in the SaaS industry versus the biochemistry industry, your model is going to look a little bit different. But the goal is, at a scalable perspective, how do I simplify it for each of those different levels there? Sometimes in the beginning, that's Excel. For more seasoned companies, that's going to be something like a tool. So when we're thinking about scalability, we want to ease the burden on the financial team and finance and accounting in general. And so those are the three kind of major categories that I think about and why it's so important to scale it in the right amount of time.
I mean, that's a very interesting perspective, right? I mean, you did touch upon how the journey of a company goes from Excel to something more advanced and complicated, right? So to zoom in a little bit onto that, so how do you think financial models of early stage companies differ from those of late stage companies?
Yeah, really good question. And it is a drastic change because, of course, in the beginning, when you're starting a company, you likely do not have any revenue or much revenue at all. I've built models for several companies where they were forecasting their revenues 2 to 3 years out, but had expenses today. So when we're thinking about a financial model from their perspective, they're likely thinking from a market perspective or a total addressable market perspective, meaning what's the total market out there that I could address? How much of that market might I be able to capture? And then how much of that addressable market that I could even capture is going to sign up to my product over all of the other products there? And that's a very high level answer. But of course, eventually every company, if they're doing the right thing, they're going to start making revenue. And about 6 to 12 months in to them making revenue, their model has to change, right? And this will probably be the first change that they make from a modeling perspective or a forecasting perspective, because now they have a base that they can work off of, meaning they have a customer list. Those customers are paying them money. So it could be as simple as a P times Q model, where we're essentially taking the price of their product, the quantity of the product sold or the service given, and then forecasting it forward. I've seen other methodologies where they use sales reps, assuming sales reps should, be able to make $40,000 of sales, per month or per year, and then you just add sales reps as you want your revenue to grow, hoping that they meet their quotas, and using that as sort of a forecast methodology. Expenses seem to find their place in the world based on revenue. This is why I typically talk about it based on revenue. Financial modeling, by far the most difficult part of it, is getting the revenue piece right. If you get the revenue piece right, your expenses, they matter less, because you can control for your expenses. Revenue you can't control for, of course, otherwise you would likely have billions of dollars from month one. But expenses themselves, they land into place when you get your revenue right.
That's great insight, Kirk. Just to take a step back and discuss financial modeling in general. So how do you think financial modeling has changed over the past few years in the context of new technology and of course AI?
So I would say conceptually, financial modeling hasn't changed that much, but methodically, it has changed substantially. What I mean by that is this: the way people are thinking about forecasting likely hasn't changed. It's going to fall into one of those buckets I mentioned before based on industry. P times Q, total addressable market. If you're a SaaS model, you're going to use the ARR, MRR corkscrew, and we can talk about that a little bit later. If you're an airplane company, you're going to use number of seats or utilization or rent or these sorts of things. Those pieces are likely going to stay the same because those are very industry specific. What has changed a lot is obviously the technology has increased, and there's a lot of non-value add processes in Excel modeling. Even though it's very quick and you have a lot of flexibility, what's not quick and what is really non-value add is the process of going into NetSuite or your other ERP, downloading your actuals, formatting them, and then putting them into your Excel model to then compare budget versus actuals. That process is something that 10-year-olds can do, right? Everyone knows how to download Excel documents, and without much practice, you can start formatting them. What we want to do is eliminate those non-value add processes by adding in a system that's going to do it for you. And this is the induction of FP&A tools that have come in to try and centralize a lot of your systems, your CRMs, your ERPs, your HRIS tools. And so one thing the drivetrain does is it centralizes those data, allows you to create metrics off of that data, and then auto updates these items. So essentially that data that you would have to manually pull yourself now is just automatically flowing in at the hourly level, and you don't need to think about it anymore. Now you can either rest, which is much needed in the finance and accounting world, or spend time on real insights, right? Drilling down into the data, finding correlations, finding perhaps causations, and making your forecast that much more accurate.
That's very interesting. I mean, since we work with a lot of finance leaders here at SpendFlow as well, and whenever we get to meet CFOs during the events that we host and things like that, one of the major topics that comes up, at least in between the discussions between the CFOs, is hey, what are the different financial modeling approaches that are out there, right? And which one to choose, considering the complexity, accuracy, strategic planning, and a bunch of other things. So
Sure.
How can financial leaders determine the most suitable strategy for their company's needs and goals?
Totally. Yeah. And this is where that people, process, practice item that I was mentioning before is super important, because you can make one level of detail model if you have 5 people on your FP&A team. You can make a much less detailed model if you only have 1 person, or let's just say half a person. Commonly, accounting FP&A teams are built out of the accounting team by somebody that just wants to take on the role. And so really it's a half role in the beginning. So from a people side, how many people do you have to really commit to this? A lot of tools are aiming to relinquish the need for adding FP&A people so you can keep your team small, let's say 2 or 3 2 or 3 people. But even that's becoming difficult as, sort of your capacity is being lost and models are becoming more cumbersome. And so really what you're trying to answer is this question is, how complex do I want my model to be and therefore more accurate? And how simple do I want my model to be, but not too simple that no one's going to believe in it? The extreme example would be just slapping on 10% at the end of each year and saying, hey, I'm going to grow 10%. People are immediately going to look at that and say, why are you growing 10%? I need justification behind those numbers. The alternative is go down to the most deep level that you can by region, by industry, by segment, by product line, by price. And sometimes it can be more accurate, but not so much more accurate that it's worth all the extra effort that you're going to put in, right? So that's the process piece. The people, how big's my team, the process, how far am I going to make this thing accurate? Where's the balance? Can I do, 60% of the work to get 90% of the accuracy? And the extra 40% of the work is only going to give me that extra 10% of accuracy. And it's obviously a lot more effort throughout my month, and I'm going to burn out my team. That's the balance that you want to find. And the practice piece we obviously spoke about when it comes to the industry. This is really going to determine, especially in the SaaS industry, how you're going to model things out. Most industries have a pretty sound, let's just say, baseline of forecasting. For example, in the SaaS industry, it's the ARR corkscrew model or the ARR waterfall, where you're going to go from, beginning ARR, contraction, expansion, churn, new, and then ending ARR. That allows you insight into, how are we, forecasting SaaS at a more granular level, but not so granular that I'm losing efficiency. That's for SaaS. But then a total addressable market model might be used for something in the biochemistry sphere when you're talking about new pharmaceuticals or something to that effect coming out. And so they're very different, but they're also important to get right, so that, like you said, we can have a scalable model that is effective for my company, but not too much where I'm burning out the people that's working for me.
So that was very insightful, Kirk. You did touch upon people, process, and practice, right? And basically how you select the strategy depends on the complexity and how far you want to take it in terms of like financial modeling. Now, when it comes to execution, so as per the complexity or like as per the requirements, what sort of tools or like strategies should financial leaders take in order to actually execute it in practice, right? So at what stage is an Excel enough, and what stage do you really need like a complex tool that like works with like a bunch of other tools that you're using as well?
Totally. Yeah. Well, I have a pretty strong opinion on this, and I actually just did a podcast with the SaaS CFO, Ben Murray, where we actually aim to answer this exact question. When does a company move from Excel to a stronger FP&A system? And the question, let me just say off the bat, is not based off of dollar of earnings. A lot of people will say, something to the effect of, if you have 1 million of ARR or 10 million of ARR, now you're ready to, move to a tool. That doesn't work, and I can tell you why. I've worked with some companies where their products or services cost $100,000 just for that one product or service. I've worked with other companies where that same, their equivalent of the product or service is $2.99. So if we're talking about $10 million of ARR, for the one company, that's going to be a lot more transactions than another, obviously. And so the question isn't, I move based on dollar amount. The question is, I move based on transaction amount. Once I reach a certain number of transactions, which is essentially too cumbersome for my FP&A team to handle within Excel. Excel's only got, 1.04 million lines, right? There are some companies that will have that many transactions. It's time for you to move over, even before that, in anticipation of this. And I say this to a lot of companies, it's not usually too soon to move to a tool. If you believe in your growth trajectory and you've reached a certain point where even with one person, the Excel modeling's become too cumbersome, it could be a good time to move over to a tool. Why? You're going to get there eventually, and it's better to learn it up front. And what we've seen a lot of the time is people in the industry are adding these tools like Drivetrain, and they're seeing, oh, hold on a second, now I don't need to hire another FP&A analyst because my modeling has become so simple that I don't now need to go in to add another person, because all of this can be managed by one person alone or 2 people alone, whatever the case may be. So it's based on a transaction amount, not on a dollar amount. And not only are you going to save time on the modeling piece, but it's going to be simpler as well, right? It's a double win there.
Of course, that you mentioned that one of the metrics that's going to be super important is the transaction amount rather than the volume amount. So, what are some other key financial metrics, at least in the SaaS world, that finance leaders should consider, and how can they be incorporated into a financial model?
Yeah, well, at this point, I was talking with a colleague about this as well. I'm always wondering what's the new SaaS metric that's going to come out. We've got rule of 40, we've got the magic number, we've got semi-new ones like the Rose formula, which is just essentially ARR over headcount, but includes contractors as well, as contractors and consultants become more important. And what I've realized is those metrics are important. What's more important is how you evaluate them. So you look at something like ARR or MRR. I mentioned before the ARR corkscrew model or the ARR waterfall. This is so important to get right, because if you get this right, you have a very predictable forecast and a very predictable plan. If you get it wrong, then you can throw away all your predictability, and as a result, you're probably going to overspend or underspend based on what your company can do. So what that really means is this: you have a beginning ARR or MRR amount, and you take a look at that at a monthly level. In January, let's just say it's 10,000. And then you've got two expansion features. One's called new ARR, one's called expansion ARR. New is truly new customers. Expansion is maybe we have customers upgrading to a premium service that we have. And then you have the opposite of those, which is contraction ARR, the opposite of expansion, or just churn, which is a customer that's left us. Now, the reason I highlight why it's so important to get this right is because at Drivetrain, we've got a lot of customers, and I don't know if two customers actually calculate this the same way. And these are very common metrics, but everyone does it a little bit differently. I've seen some customers that any customer that enters the door for them is new ARR or new MRR. And if they leave, it's churn. But then I've got other customers where they look at it like this: since they give a 3-month free trial or a freemium sort of plan, those sorts of things, they do not count a customer that has entered within 3 months and left within that same 3-month period as either new or churn. They don't count them until the 4th month, right? And so this is obviously very business specific. You want to make sure that it makes sense for your business to get it right. Every product and service is a little bit different, and you want to make sure you account for that. If you can get those pieces correct, new, churn, expansion, contraction, you will have a very predictable SaaS model. Once you focused on those, then worry about the other thing. Worry about your rule of 40, worry about your magic numbers, worry about your Rose formulas. Those things are important, and you can definitely calculate those, but you're not going to get any of the complicated sort of fun metrics right unless you get the foundational ARR and MRR views correct.
Understood. Of course, you talked about the 4 major metrics that the finance leaders need to keep in mind before they start building out the model. But typically, what I've seen at least happen with a lot of companies is that when they're starting out, at least in the early stages, they try to be a little bit more scrappy, right? Like rather than worry about scalability, they start off like, hey, you know what? Something's better than nothing. So I'm just going to get started with this. And then sooner than later, they actually find out that, hey, you know what, this is not working. And then they try to move on to another model and things like that, right? So when you're starting out or as you're building out your financial model, so how can financial leaders, ensure that their models remain scalable as their companies grow and evolve?
Yeah, well, I would say this: you're going to make your models more scalable if you're doing things more or less right from the beginning. So how can you do that? There's a lot of great resources out there, right? On LinkedIn, you're going to find a variety of items of how to, track your SaaS metrics properly, how to build a financial model. At Drivetrain, we have an endless blog full of methodologies and financial models that people can download. And then these are all in Google Sheets right now, where people can take them over, model out their SaaS business within those sheets, so that when they are ready to jump to a tool like Drivetrain, they've already been thinking about it the right way. They've been thinking about it the way that systems interpret data. They've been thinking about it the way that their business and industry needs to interpret that data. So if you start small, let's say you download a Drivetrain Google Sheets model, and you're modeling out in that way, by the time you get to Drivetrain or to a tool like Drivetrain, you're already going to have been doing it right the whole time, that the lift is not going to be that hard, right? So get it right from the beginning. If you're already in a little bit, refresh, right? there's always a new template that you can download, rethink it. Eventually, if you're going the wrong way, the person that turns back sooner and goes the correct way is the person that's ahead, right? So just get it right in the beginning, and then further down the line, you're going to thank your past self a lot when you have to then do a full implementation of a brand new system and rethink how you're doing your modeling.
Got it. So, Kirk, we've been talking about what people should be doing to build out a scalable financial model, right? But now I just want to touch upon something that they should not be doing. So, what are some common pitfalls to avoid when people build out their financial models?
That's a really good question, and you've probably saved people hours just by asking the question. So the biggest, by far, the largest pitfall that people fall into when they want to do modeling is they want to do the classic financial accounting methodology of getting it right to the cent. And in historicals, that very much matters. Auditors care about that. Accountants care about it. They have to care about it. We're dealing with real historical numbers that actually happen. And we need to have a level of accuracy, a threshold that is much higher than forecasting. You do not need that on the forecasting side of the FP&A side. And if you do focus on that, you're going to end up on that spectrum on the right side that I was saying before, where you get so complex that your model to update it is 2 full days of effort, all of these systems worth of downloading. You're going to be spending 2 hours formatting. And I've fallen into this trap before, and I'm sure every finance leader has had this trap before, where they're forecasting at such a deep level because they want it to be accurate that it ends up costing them, 2 or 3 financial days a month. That is the biggest pitfall to avoid. If you can find the balance between this is concise enough, this is complex enough, and it will not charge my team, 3 days across all of them and make them stress out that they've missed, one cell that's going to break the whole model across like a 42 tab model. That's what you need to focus on. If you can get that piece right, more or less, you're likely going to have avoided a lot of the pitfalls, because in Excel especially, having a single formula across every single row is very important, but there's always going to be the need for a hard code somewhere for some reason. The smaller the model, the more simple the model, the more likely that's to occur. But of course, not too simple. Otherwise, people aren't going to trust your model at all. They're going to think it's just something you've superfluously made in order to appease the CFO.
Super. Thank you so much for that, Kirk. I think you mentioned hours, but I'm actually thinking you saved days for some of the listeners out there. And of course, finally, I want to touch upon a few emerging trends in financial modeling. So, what do you think are some developments that's happened recently that finance leaders should be aware about?
So I think everybody's a keyword or hot word is AI. And everybody wants to see how this sort of AI piece is going to layer on top of financial modeling to essentially improve the process and make it easier for FP&A teams to get more accurate results and make a model quicker. And I do think from what we've seen, there's a lot of room for that. In financial modeling, you've got 2 pieces working together. There's the science piece of it, which is the accounting and finance. That is this is true accounting. You've got your income statement, your balance sheet statement of cash flow. That scientific piece of accounting is not changing. That part is where AI can really help, because those scientific pieces is what AI just excels at. The other piece of it is the artistic piece, and this is the creativity of how am I thinking about my model. I don't have to think about the SaaS industry in a specific way. I don't have to think about the airline industry in a specific way. That piece means that the user is able to create a financial model that makes sense for them, or for their individual company. So where I think AI can help is on the first piece, on the scientific piece. On the second piece, it can definitely make an attempt and add some value, but it's going to be much tougher to sort of replace the time that people are spending on the financial modeling there in that case. And so one thing that it can do is, let's just say you have a financial model and you were to ask some equivalent of ChatGPT, okay, give me 5 takeaways about this model. Of course, in the future, we're going to be able to see answers such as, you missed your budget, likely because or likely driven by 3 of your 5 sales reps who didn't hit their quotas. Had each of your sales reps increase their quota by 10%, you would have exceeded budget by 20%, or something to that effect. So these sort of insights that we can draw from it, those will be extremely valuable, because rather than spending all this manual effort to get those insights, AI is going to be able to give it to us really quickly, which will just essentially make the market substantially more competitive. Because now, instead of 3 months down the line increasing the quotas for your sales reps because you already know that they're at capacity, you can do it 3 months quicker, right? Imagine that multiplied by all of the other insights that could come out of financial modeling, and you have a very competitive market accelerating very quickly. I also foresee this as a result having less people in the FP&A space. Even though at Drivetrain we've typically seen FP&A, CRO, or any sort of revenue operations and HR teams using our tool, I do foresee in the distant future less people using that due to AI. It's not there yet, but I can see that coming.
Got it. So you just touched upon a few things that you see are going to be future developments as well, right? So how can finance leaders stay informed and adapt to these evolving trends to, stay ahead of the curve?
I would say the best answer to that is keep up to date with the people that are really interested in it. For example, I mentioned earlier the SaaS CFO, Ben Murray. He loves it. We've got the FP&A guy. He's posting stuff constantly about all of these different types of models. A lot of these guys are very much SaaS-based as well. At Drivetrain, we have an unlimited list of blogs. Just go take a look through them. You won't believe how much you're going to learn, even if there's things that you think you already know. There's this great quote that says it's the job of great teachers to return us to the simple truths that we are so reluctant to accept. These blogs are filled with great information. And if you take a look at them, you're going to learn something out of them. If you keep your finger on the pulse of the industry, you're not going to get distracted by bad modeling practices, or you're not going to miss the key insights that come out, and you'll very much be a part of it. If you're a part of it and you know what's going on in the industry, you're setting yourself up for success when you do have to jump to a tool or create a more complex model.
Got it. So I think we've come to the end of the episode. And usually, Kirk, what we like doing at SpamFlow is ending the episode with a little bit of levity. So recently I watched this movie called Dune, and the main character, basically Paul Atreides. So he gets his power to sort of see multiple futures all at once. They call him the Kwisatz Haderach or Lisan al-Gaib or something like that. So what would you do if you can get that power, right? Like maybe there's a chip in your brain with AI or something like that. So what would you do if you see multiple futures all at once?
What would I do if I could see the future? Is that what you mean?
Yeah, so I mean, we're talking about financial planning and analysis, right? So what if you could see into the future and model it out all at once, right in your head?
I think what I would do is if I had the capability of doing this, is I would model out every single public company on Earth in my mind based on my forecast, and compare it to what actually happens. Then evaluate where I went wrong and why. Because what normally happens is nobody questions things when they go right. When your forecasts are accurate, everyone goes, yeah, you were meant to make it accurate. What people are really interested in is finding a pattern of why we get it wrong. And so I would love to find a unifying answer to the most common reasons people get it wrong. Are we overestimating? Are we underestimating? Why are we doing that? And how can we model just a little bit better? There's this great book by Philip Tetlock called the University of Pennsylvania called Super Forecasters. And he tracks people that are essentially have a higher ability to forecast than others. And so I'm imagining my Paul Atreides mind being one of those super forecasters. And I think that would be the best way that I could put my powers to good use.
Super. Thank you so much for joining us today, Kirk. It's been a pleasure to host you and understand what the future of finance holds for all of us. What an amazing episode. I'm sure our audience will have learned a lot about building a financial model that scales as you grow. You can, of course, connect with Kirk on LinkedIn to continue the conversation. Check out the episode description for his LinkedIn and any additional resources that you need. Until next time, stay informed, stay inspired, and keep thriving in your financial journey. Thank you for tuning in.